smart. I can make a recording and play the recording. Okay, that's my homework assignment. Anyway, so access to this webinar is for educational informational purposes. Only consult a licensed broker or registered investment advisor before placing any trades, all securities and orders discussed in tracks. Our monitored and virtual trading accounts, virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, agents, representatives, or independent contractors in such capacity as licensed financial advisors, registered investment advisors, or registered broker dealers. Nothing in today's webinar website or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment security or transaction. Trading options involves a risk. Visit the OCC website, www.optionsclearing.com, to read characteristics of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not applying guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and the results discussed in this webinar are not typical and only valid on the specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless. Many losses you may incur as a result of the information discussed in the video identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not read or sell your information to anyone. All right, fantastic. All right, so let's see what's going on. We are plowing up to the highs, very nice, moving nicely. The Russell is well on its way to our 1470 goal. Everybody else is in their zones already. So we're just waiting for Russell to catch up a bit. Well, we're also waiting for the S&P to hit 2600. That's going to be key. That's a big bounce line for them. Once we get that, we're in good shape. And I don't think we're going back to the highs, but getting over the strong bounce lines, then we can start consolidating up there and show that this is a good area to be trading. Let's see. I gotta tell you what's exciting. I mean, we crushed it because we got bullish. Despite everybody screaming and crying about it, we turned more bullish at just the right time. The options opportunity portfolio plowed up to 69% now. So that's very nice. It's now up, that's $170,000, I suppose. The biggest thing that happened is SCO, because last time we did this, SCO was way up there, and we were down $10,000 on the score. Now we're up $10,000. So it flipped like $20,000 for us on SCO. So that's huge. It's 2020, so we should probably take it off the table. We didn't intend to do this. We fell back into that position on 1226 because we were so badly burned that we figured we'd give ourselves more time. But now that we got, now we've made $20,000 on it, we don't need to keep this open and risk it for the year. On the other hand, though, at $30 is very, very low price on oil. We really don't think that's going to happen. So the question is, it's $8,100 that we're going to collect at some point, but I don't know. It just stung so badly when we got hurt on it before. But that really accounts for why this portfolio is now looking good again. It was down significantly, and a lot of it was that position. The Apple puts are still really bad. They're killing us. But overall, I mean, it's generally holding up very well considering the riot that's gone on in the market. I have to do a proper review. We've got, what's the calendar look like? Next week, so next Friday, we've got to be flipping positions. Now, Tuesday and Wednesday next week is Benzinga's Cannabis Investing Conference. I have to go the 15th. There's only 100 people from the whole country invited, and I'm one of them. So I think it would be kind of shitty of me not to show up. I'm not sure what that's going to make my schedule like on Tuesday, and then Wednesday is the general conference day. I still want to see all the exhibits. I'm going to be there, but I'll try to put in a little bit of time next Wednesday. But Tuesday, I might have to be completely off next Tuesday. Anyway, so that being the case, that means even though it's in Miami, close to where I am, I'll put a full day in Monday. I'll try to get some portfolio adjustment stuff up Monday. Tuesday, not obviously Tuesday, nothing will happen. Wednesday, I'll get back. I'm going to come back Wednesday, and I'll just have to work my ass off. And Thursday, Friday, we'll have all our adjustments in. So it'll be a little crushed for time. But you know what's funny? Because like last time we did the portfolio adjustments, we really made very, very few. I don't know what day that was. I want to say the 21st. Let's go with the 21st and see what happens. Back. Boy, I put a lot of Trump. Was it Friday, December 21st? Maybe. Okay, let's see. Boy, I do put a lot of Trump pictures in for the front, don't I? I just did so many funny Trump pictures. I like funny pictures. LTP. Oh no, wait, that's not the right one. That's not when we made the adjustments. That was when we adjusted Philip Morris. All right. I don't know when we did that then. When was December expirations? It was the 21st. That is a Thursday on the 20th. Try to find the last time we did the LTP. Not that day. 19th. I was really on the ball if we got everything done by the 19th. I find that hard to believe. Oh, there it is. What do you know? No, wait, that's HPI. No, I just mentioned it. I don't know. I'm confused. We brought back all those short Apple calls. And then we roll down the apples. So that's also helping, by the way. Although we don't have it in the OOP, we were because we had fallen a lot. We were only up about 30% when the market was really crushy. So we weren't in a good position to add the Apple bull call spread. So we just have these short puts that we're riding out. They were very painful, especially a week ago, and they're still painful. But we weren't of a mindset to add a bull call spread, even though I thought it was like probably the single best trade you could make. But anyway, so that's the OOP. The money talk is really fun because that one we don't touch because of the show. They just called me yesterday. They want me to come back on. I'll be on at some point in the next few weeks, I think. So we're back to 90% there. We had gone down to maybe 65%, so a 30% swing from when the market was down to where it's up. This portfolio has hedges in. It has the SQQs, has the TZA, and of course, oh, you know what? This portfolio is up even more than it looks because I got to fix this. This still says ABX and all the numbers are zeroed out. So we're probably up over 100%. Because right now this ABX trade looks bad, but it's really not because it's they changed the symbol to GOLD and we're in the money. So that's a big booster in that position. But anyway, so I don't touch this portfolio unless I'm on the show, and I've been on the show since God knows when. Probably figured out 10:25 apparently is the last time I was on the show. So that's the last time we made any adjustments. And so we rode out a hell of a storm in the portfolio. Look, it went down from like 90 to 65, and now it's at 100. So I mean, it actually improved itself by not being touched, which is interesting, right? During that whole dip. And not only that, though, we're still below where we started. It's just that all the short, now that the VIX has calmed down, all our positions look quite a bit better, and all the short premium we sold is doing well. Then we've got the short-term portfolio is ridiculous. It's now up. It's now up 560%. Because we cashed out because we flipped bullish on all these on the hedges. You know, we see this minus 300. These are all the leftover hedges from our first round, and we sold 300 short hedges. We're now up 107,000 on the short hedges after we already cashed in 100 and something thousand on the long hedges, on the long TZAs, because we took that money off the table. We left these short hedges and we bought this spread. And you see how this spread is only down net $13,000, right? Down 55, up 42. So we lost 13,000 on this spread while making 107,000, because that's from 1226. So we on 1226 we consolidated all of our short calls to these TZAs, the 15s, because my thinking was that they would it was way too high and it would calm down. So TZA. And this is how we've made all our money in the short-term portfolio. It's just by we have the hedges, but then once the hedges pay off, we still do the fundamental math and we say, no, this is too much now. The correction's gone too far. So when we made this adjustment, we took the money off the table. We took our long TZAs off the table here, because I said that was silly. And then we left the short ones. We consolidated. You can see we're at 1226. We did just exactly the right time too. Not to toot my own horn. I mean, it's fortunate that this works out. Now, I hate to make adjustments when it's not expiration week. So I really do bite my tongue and wait mostly, unless I really feel it's urgent we make an adjustment. I really tend to not make an adjustment until that expiration week. In this case, we go on the 26th. We decided to make some major changes because of the way it spiked up. I saw this and I said, that's not sustainable. And we said, you know what, we got to take this off the table. You can't make this much money. You can't go from 10 to 18 and not take it off the table. But we were worried it would still go higher, so we hedged by picking up a 15.25 bull call spread, right? And that was to net $1.80 on a $10 spread. So we could still we still had $8 of upside on that spread, protecting us to 25. And then we sold the 15 calls for 460. So we could have been still screwed, but at least we had some protection up to there. And it turns out that it worked out exactly the way we thought, and we turned positive. But what did we make? Just this adjustment here. Buying this spread and selling these calls made 107 minus 13. So I don't know, 104, $94,000 we made just on that. And that's why we have such an insane profit now. I mean, we just made 94,000 on that spread. We probably made similar amount of money on the QQQs, on the SQQ spread. We just pulled the moves off at exactly the right time. And it's probably like the third, fourth time in the year that we've done that, because we've just taken advantage of what the market is doing. We get these incredible drops, and then the government steps in and saves us. It's a pattern. And I said for ages, I think we're going to get a 20% correction. I said that since the summer. I was wrong all summer long, because we went up and up and up. But starting in the summer, I cashed out my kids' college accounts. I told you guys all that, at the end of May or July. I forget what it was, May or July. I remember. No, it was May. I know it was May. So at the end of May, I thought the market was overpriced then, and I was right. It was overpriced then, because now we're lower than that. But I just didn't want to risk anything that was important, and I couldn't hedge my kids' college accounts. I think I told you guys at the time. You can't hedge it. It's just a bunch of, you have a choice between a bunch of ETFs. In those, I forget what it's called, a 515 plan or whatever the heck it is, but whatever college accounts are. Anyway, so given the choices I looked at in the brochure for these guys, I was looking to see what I could do to lock in the gains. The only thing I could see to do to lock in the gains was go to cash. And my kids' colleges are fully funded. And so all I'm doing with the money now is just risking losing it. And a 20% correction would have lost me a year of college. That's insane, right? So there was no reason to take that risk. So I did that. I cashed out my mom's stuff. I cashed out because she can't afford to risk it. She's not earning money, so she can't afford to risk what she has. So a lot of my family, I told them to cash out their stuff. They were all pissed at me during the summer, and the market kept going up. And then all of a sudden, they were all happy because the market went down. You've got to, if you're a fundamentalist, you can't regret the fact that you're too early or too late. Especially when you end up being right in the end. And I know, as we went up and up, I just got more and more bearish. And I've said to you guys before, I said, look, unfortunately, I tried to restrain myself because this is what happened to me in 1999. In 1998, I thought the run-up was ridiculous. It got more ridiculous in 99. So in early 1999, I told everyone to cash out. I said, cash out, this is bullshit, this can't possibly sustain, blah, blah, blah. The market went up 100% more from where it was when I said it was too toppy. Then it went down 80%, wiping out, way below where I said it was too toppy, but it was a year later. So my timing was terrible. I was right about the value, but I was wrong about the timing by a mile. That's the hard part, is to get the timing right. But the value, I'm really good at. It's like if I say somebody's worth something, I'm usually right. So it's just a matter of like the timings, and it's tricky to play. But in the short-term portfolio, especially, we have nailed the timing, because I have been able to wait. And the reason also that in the short-term portfolio is because they're just hedges. So when they pay off enough money that it's worth going to cash, we go to cash. And we are in cash. Look, we have 734,000. We have more cash than we do value. The positions are net negative. But we have a ton of cash. We cashed everything out and left ourselves a net negative group of positions. And why are they so negative? No. Oh yeah, I guess we do. We have a lot of shorts that that we're responsible for here. So it would cost us $70,000 to get out of these positions, or $74,000 is right there. But so what? Then we're left with $660,000 in cash. We could just shut the whole thing down and have the cash and use that cash to buy long positions. But fortunately, we don't need to. I mean, that's how the short-term portfolio is designed to work anyway. So we're doing what we're supposed to do with the short-term portfolio. When we get a ton of cash, when we have a big upside in the short-term portfolio, we convert it to cash in case the long-term portfolio needs it to buy stuff. Because the long-term portfolio, as we just discussed, is designed that you take a bigger position when the market turns against you. Fortunately, though, the long-term portfolio has not needed it, because the long-term portfolio is up, wow, it's a lot of positions. The long-term portfolio is up 67% now. And that's funny, it was just up 61% before. It's up 5% since a couple hours ago when I was looking at it last. This is just crazy stuff. I mean, it's because the VIX goes down. I told you guys that when we were down before. We were down like 40% or something like that in the long-term portfolio. But I said a lot of it is the VIX went against us, and that caused all these short sales we made to look bad. We're the same long-term portfolio. We moved to a lot of cash. We have $700,000 in cash. So, the securities we have very little total value. But we went over these positions, and we went over the OOP positions, but they are a freaking gold mine. I mean, they're going to make a fortune if they all work out. But right now, they're not worth very much. All these short puts, obviously, are not as good as they could be because of the sell-off. And I'm not going to go over the individual positions. Look at Apple. Apple's killing us with the, God knows what, that $52,000 loss on Apple. Oh, I'm sorry, this isn't even correct. We have to adjust this because this was rolled down. These 160s were rolled down to the 140s. I think that's the only move we made. We don't have a cover. And we'll have to see what else we did. But I haven't made all the changes that should have been made in this one yet. I called for that one last week. I think we did the roll down, right? Or was it earlier? I don't remember what it was, but last week I think we did the roll down on positions. And that's what we're going to focus on in next week, is we're going to focus on who can we still roll down. In the options opportunity portfolio, I already called for some roll downs on positions. That was important to take those positions. We didn't have a lot of cash, and so the best time I wanted to do it when it was optimum to do it. In the LTP, it really isn't that important because we already have a lot of major positions. And also, frankly, I mean, up 67% for the year. It's like I still have this temptation to like cash it out and start again because it's just there's so many positions now. I don't want to add any. And if I don't want to add any, then what are we going to do all year? We're going to sit here and stare at these. So I got to think about that. 50, look, 50 spreads. You know, and I like them all though. I went over them. I keep going over them. I'm like, I like this one. I like Amgen. I like Bed Bath and Beyond. I like BHC. I like Citibank. I like Cheesecake. I like Coeur-d'Alene. I like Celgene. Celgene's fantastic, right? And we have another Celgene position I didn't even enter yet. CHK is just starting to come back. They're going to be a good one. China Mobile, one of the only Chinese stocks that's actually doing well. Chipotle, we were just having a discussion about. We're getting a little bit burned on the short calls, but we'll be okay. Caesars is coming back nicely, so that's going to be a good one in the future. Delta, Disney. Disney is amazing. I just got back from vacation at Disney. We're getting burnt. Wait. See, this is one that should have been rolled. We have the 120 calls. Definitely got to roll these. Ford is not going to stay down, so they're good to have. FCAU is Fiat, that's good too. Frontier, yeah, one day. GE is coming back finally. Look at this. This is our new GE position, right? We added 100. We didn't add. We rolled to the very aggressive January 8 calls in 2021. We picked up 100 of them. We doubled down our position because they were so cheap. Who cares? 250, and we have a little profit already on those. We're in a very nice position now for GE. If they actually come back, this thing's gonna make us a fortune. We got Gilead, we have Gold, which was the old ABX, GoPro, I don't know why that's still there, that's one we can get rid of. No, not because I don't like GoPro, just because I really don't want to have so many open positions. It's just such a pain in the ass to go over. HBI is our last year's trade of the year. Hopefully this year they make the money they're supposed to make. H&R Block is also, it's a, you know, we don't really expect that to go that long. IBM is our trade of the year for next, you know, our trade of the year this year, 2019 is IBM, so we like them. IMAX, I always like when they're cheap. International, I mean, look, they're all good. These are great positions. This is a fantastic portfolio. Holy cow. I mean, and I'm really, you know, so I'm much happier with the targets now. So all we're going to do is do some fine tuning here. Anyway, my point was last time we did the portfolios. Oh, Mike says December 26th. Okay, thanks, Mike. I appreciate that. For OOP adjustments. All right, let's see. That seems late, but I'll take his word for it. I'll take a look. So let's see, December 26th. What's this, 20th? So that would have been probably gotta go forward. Oh, there's 24th. So it's gonna be at the bottom of this set. But I was looking to the LTP actually, but no, you say the OOP. Okay, well, okay, we do have that review. I don't think we made many adjustments here. But where's SCO? Yeah, look at SCO. It was minus $14,000, and now it's and I guess, do we adjust it? Okay, let's put this up here. Okay, so now I gotta go back home. You know, I want to, you know, I think it's a good time to talk about why we do what we do when we do it, because, you know, I mean, this is a good time to review because we just went through this crisis. And so why did we make these moves in a crisis? It's a good time to think about that. So yeah, SCO. So here's what I said. This is one of the things that are killing us. Oil went a lot lower than we thought. The 15 short January calls at 12.20 can be rolled to 20 July. So what did I do? We were getting killed, and I mean killed. This was minus $14,000. Okay? and SCO was at 32 that day. It was really kind of at the top of where it was. Look. See, this is great because you can do like a forensic on this thing now. Look, see right here. I was like, this is freaking insane. So I just want you to understand my thought process, okay? And oil was, well, let's get another chart. See, we have a chart for everything. All right, I hope this is interesting to you guys. I mean, for me, I just think it's really important to do this as far as like, you know, why were we doing this? What were we thinking and why did this happen? So it was on the 26th. See what happened here? So oil was below, hit 42.50. 42.50 was, I had said previously, was as low as I could see it going. So, you know, if you do an analysis of something and, all right, well, not to be egotistical, but if somebody who knows what they're doing does an analysis of something, I mean, not if any random person does an analysis, but you know, once you have faith that something is going to do what you think it's going to do, you have to act on it. You can't project. And I ran all numbers. We talk about oil constantly, and I said, look, if they you know, 42.50, below 42.50 is not likely. 40 is going to be bouncy anyway. You hit 40, you're going to bounce back to 42.50 because he came up from much higher. So you're going to have at least a $2 bounce from 40. So 42.50 was a great bottom to play off of. And that made it a good day to do the adjustment. So, you know, so I'm thinking it's really spiky, and we're looking at this and saying that's crazy. This is what 42.50 represents on oil. So unless oil goes significantly lower, SCO wasn't going to go much higher. So even 40 would maybe hit 35 or something like that, but then we're bound to bounce off 40. But I wanted to do what? I wanted to go to, what happened to the thing I was writing? I guess it's here. Okay, sorry. All right. Why I get it, because I was showing you the thing. So we had this thing that was down $14,000. So I'm looking at this thing. What are we going to do about this thing? Oh, and look at these TZA short calls that were killing us too. That's another 28,000. This is why the OOP jumped so much. It was only at. Is there part 2 to this thing? Yeah, see, we made a lot of OOP adjustments because, as I said, it was because it was much smaller than the LTP. We don't have, you know, the LTP STP is doing fantastically well. The OOP was down $40,000 since 12/11. So basically, I think as far as I remember, it's down around 40,000 or 35,000, something like that. So this needed attention. The LTP did not, because even though the LTP was down significantly also, so, well, this is indicating we were almost flat, actually. Let's see. As I said, look, the good news is we have 132,000 in cash. It's a negative 38,000 value of our position that's killing us. And those are what we call paper losses, but paper losses become realized losses if you aren't careful. And that covered everything we did this day. So we took a pounding, the market was at the low, oil was at the low, everything was at lows basically, and we looked at each position to decide what we were going to do about it. So here's this SCO that went hugely against us. So I said, look, these 15 short calls, which are $18,900, we can roll them to 20 July 30th. Why do I want to go? First of all, January 20, I didn't expect to come back by January 20. You know, I didn't see that happening. We are kind of coming back, but it was highly unexpected. They were short January $20 calls. So had we kept them, we actually would have done almost just as well. But we rolled into higher calls, 30s, that had at 880 that had much more premium than the 20s at 1260. Because if we're at 32 and the 20s at 1260, they got no premium. So I took the no premium and I moved into positions that had a lot of premium. Now, the problem is by giving it more time, even though we made back a huge amount of that money, we didn't make it all back yet, but still the turnaround is phenomenal. Okay, so we went from a $14,000 loss to a $10,000 gain. So that's just gigantic. and we're totally thrilled with this position now. I honestly don't see getting back to 30 in July. And why did I go to July? Because July is when the summer driving season starts. It's right after the Memorial Day holiday or Labor Day or whatever they have in May, whichever one it is in May. And so, and also I expected that by then OPEC would do something. I figured by February OPEC would do something. Now they already did something. So oil popped a bit. Although today they had a horrific, like a 20 million barrel build in oil, in not in oil. Oil was down a couple of million, then distillates and the other thing, gasoline distillates were miles up, like huge pileups. So there's a big demand problem, and they're in big trouble. So I still don't think we're going to go below 40 because OPEC will do something else. They're obviously determined to not let oil slip below $40 or $50 for Brent is what they care about. They're like $50. We are maintaining freaking $50 a barrel for Brent crude. That's what they care about. So, you know, and I felt that they have the ability to do that. So I felt comfortable with that kind of change. But, you know, look, doing that change, you know, this is what you have to do when something goes against you. You can't stare at things like a deer in the headlights. Although, as I said, if you had stared at it like a deer in the headlights, we'd be in pretty good shape right now. But either way, it's you know, there was nothing wrong with doing this adjustment, and it was logical, and that's why we did it. Now, TZA, I just put out an alert, maybe the same day, with the STP that we were doing a lot of adjustments, and so I, you know, put that was so important on this day that we did that I put out a special alert for the STP to change the TZAs and SQQs. As I said, that's why we made all that money. So we did the same kind of move here in the options opportunity portfolio. 50 short, April 15 calls. I assume it's reflected. I think we did all the adjustments on here properly. TZA 50 short, April 15. That's it. Okay. So we made all these adjustments. And I said, we're going to roll out short January 12 calls to short April 15 calls. So we rolled them up to a higher strike because TZA was also killing us, right? But I didn't think it would last. I didn't have faith that we'd zoom back down to 12 like that. That was unlikely. So you can't cross your fingers and hope that's going to happen. Although again, it's the same kind of situation, right? Had we just sat there, it would have fixed itself anyway. But we took the 50 shorts and we moved to 50 April 15s, and we took a small hit, but we sold them for that. So we have like I said, we have a $3,000 loss against the Success Lescas. So now we have a higher target, much safer, and we think we're going to be able to stick with it till April. So that's our plan. Still, we don't want to get burned again, so we added 50 of the 15-25 spreads just in case it kept going up. So we took the 15-25 spreads to cover the short 15 calls on TZA, just in case. And it's the same situation we have with the short-term portfolio. As you can see, the spread, the 15-25 spread here, sorry, this one up here and this one, the 15-25 spread is -14 and +9, so net -5, right? And then +18. So basically 13,000 net profit on those changes. And you have to compare that to where we were at the time, which was, well, what happened to it? Why is it being weird? Oh, I'm sorry, you compare that to -28,000. So again, massive turnaround because we repositioned. We took this position that was hurting us and we repositioned into something that made more sense. And these, by the way, were leftovers from another spread we had cashed out. So honestly, we actually, you know, we already had a ton of cash in the portfolio from that. That's why we had so much cash sitting in the portfolio. Apple, our faith in us is has a negative 27,000 position at the moment. but I have no problem with targets and no change. So I was talking about these, and they were minus 20, oh, they're net 27,000 minus over there on the apples. They're still not good, but they're not as bad. Now they're, but I said no change because I don't see any reason to change this target. So why are we gonna, we're not gonna use any firepower. Then now it's minus 24,000. Really hasn't changed that much. It's like, why change this? Why am I going to use firepower to fix something that I don't think needs fixing? Because again, it's like you're adding, you got to be careful of your margin and what are you doing and where you're moving it to. LB, we rolled down the puts to take advantage, and here we just rolled the puts down to we went from 10 2020s to 15 2021s. Play is a new thing, so we didn't worry about that. Joe is coffee. We brought back the short calls to see if it improved. It's been improving since then. Here's where we did it, and now we're up here. So we'll see. ABX. ABX Southern was doing well. ALK, and again, we were talking about this. I think we talked about last week. I call it mechanically. I say that a lot. I say it's mechanical. In other words, non-emotional. When the market is strongly down for what you think are not particularly good reasons. Sorry. Make that stop. I had the same problem in my old place too. I just have no idea how to work these kind of phones. So when the market is down or up for some particularly no reason that you think is not going to last, you have to make the mechanical move. You have to take your emotion out of it and say, look, what do I do when ALK is all the way down? Well, it's all the way down. So if I think this is a bottom, what do I do to take advantage of a bottom? And what did I say we did? We're going to take advantage of the drop. We're going to roll our 9 short puts to 10 short puts a year later. So we go in a year out and we drop $10. And then we drop to the 50 puts, which are now way down here. So what did that do? That saved us margin, and it gave us a stronger position that we were more likely to win. I said not because I had lack of faith, but we were ahead on the puts because we weren't behind. We already sold them for a good price down here or here. Whenever we sold them, we had a really good price, but it was less margin commitment, and I was worried about that at the time because we were squeezing our margin kind of close. And I said we can buy back the short 70 calls. Okay, why did we buy back the short 70 calls on ALK? ALK, January 70 calls. And by the way, notice it's 5 and this is another thing it's hard to get your mindset around because I'm like, so I used to have a very bad habit of not worrying about things. If it was only 5, I'd be like, oh, I'll get to that later. I don't do that anymore because it's like, because especially in the smaller portfolio, you can't afford to say, oh, I'm going to ignore 1,000 here and 1,000 there. If you have a chance to make an improvement in a position, you make an improvement in a position. It's not about whether it's a big position or a small position. You have to do what's right. Oh, we didn't do the adjustment here yet. So the adjustment's not actually reflected. Oh, that means I got a lot of work to do. Oh, no, I'm sorry. Silly me. I'm looking at the old one. 60, 70, 50 puts. No, we did do the adjustment. That's the old one. I'm like, why is this all the same? So why mechanically? We were up 50% on this position that doesn't expire until 2020 for another year. So I said, you know what, let's take advantage and take it off the table. I mean, we got a really nice 50% gain on this, which is all we need, and we took it off the table, and now we said when it bounces, we'll sell something else. Oh, actually, I don't know if we did that. What did we actually do? I should pay attention to what we actually did. I'm not sure I said that. Okay. Now that we're overexposed, okay, now we're not overexposed. We can buy back the 5 short 70 calls, and oh, I see. I didn't just take it naked though. We bought it back and we rolled our long calls down, and we increased the size of the position to the 60-70 bull call spread. So we've gone from a $5,000 spread to a $15,000 spread, and we spent $4,200 to do it. So we increased our position by $10,000 for 42.50, taking advantage of the dip to move ourselves from a okay. We moved ourselves from a 60-70 spread to a longer 60-70 spread. I thought we went lower. But we took advantage of the cheap price to buy here. Oh, you know, and I'm sorry, you know why? Because my mindset's like, I have to remember what my mindset is. We went to 15. We went from 10 to 15, but we kept the spread the same because we didn't want to spend a lot of money. Because again, we were tight on money at the time. Now we look like we have a lot of money. Then we didn't have a lot of money. We had cash, but the net of the portfolio was not very good. And so I didn't want to do things that cost too much. So I was very sparing with how much money we deployed on this one. It's different in the LTP because the LTP is swimming in cash, and the STP has $500,000 it doesn't need. It's like it's supposed to be giving that money to the LTP, but it doesn't because the LTP doesn't need any money. So why, we're not going to transfer it if we don't need it. It's just sitting in the STP, and we can do some fun gambles with that cash. Because now we can do some interesting stuff when you have that much cash and margin sitting around. But we haven't. The LTP has never had a bad enough time where it needed money. Best Buy. Oh, you know why also? Because remember that time that I forget when it was. It was a couple of months ago when I put up like 9 positions we added to the LTP that were going to make $100 and something thousand if the market dipped, and they did. Because the market dipped, so that was an extra $100,000 of like of hedging that we put into the LTP, and that's why it's got 50 positions because I added those 9 new positions. I can't find that article. I looked for it already. So Best Buy, we had a small short put position, so we rolled that. BHC, it totally collapsed. See what it said? Totally collapsed. Back where we came in, back here. I don't think they did anything wrong in particular. So let's just do what we're supposed to do on a pullback, which would be, and BHC is the old VRX. So there's nothing changed, nothing happened. I don't know why it pulled back like that. And I said, well, see, I don't know why it pulled back. I don't see what's wrong with it. So we may as well roll the 5 short 2020 puts to 5, not taking more, but I'm taking advantage of the fact that I can roll out. And in this case, I felt this was such a stupidly low price that I rolled up to the 20. So we actually went to higher puts, put more money in our pocket. I won't pay $275 for the 2020 22s. Oh, I regret that already. But the 10, 20, 20, 15 calls at 580 can be rolled. So we rolled, oh, I see. So I left them hanging. And we rolled to 20, so we went from 10 to 20 of the long spreads, and that's net in pocket, and now we have a 20,000 long spread protecting our half short calls. Well, now those shorts are already in the money. They're the 2022s. I don't think though, these 22s, I don't think that we're really going to be up at higher than 28. I think we'll probably be around 26 when we settle down, although it is moving really fast back up. Citibank looks like from 75 to September 50 now. The June puts are hurting us, so we'll roll the puts. We closed out the short June 70s to get more aggressively bullish. We rolled the June 60 calls to the 2021 55.70 spread. And here I said, so look, the whole change is costing us $14.50, but we sold those June 70s for $14,500. And we'll say, we'd already collected cash. So this change made for $14.50 and massively improved our position. CDE not doing well, but as ABX still beginning to recover a bit. How's CDE doing? They should be doing better now. CDE. Yep, nice. So again, they were here and now they're here. Not huge, but at least they're progressing. There was no emergency with them. FCX, relatively new, we left it. FNSR, we left. FTR, it doesn't cost enough money not to double down. It doesn't, it's only $3,000 to double down on the position. So we bought 1,500 more shares for $2 to see how things went. So down here, I was like, I'm sorry, at $2, I'm gonna freaking buy more shares. It's too cheap. And it goes back to that same thing again. It's like, you have to know what if you don't understand the company, you shouldn't own it. If you don't understand what it's really worth, if you don't strongly know what the company's worth and what it's doing, and if good, you have to know what good news is and bad news is for the company too. And if you know all that, you're going to feel like you're in control. But if you just buy random stocks just because somebody picked them, that's never good. Like get to know certain things. Decide what you're going to be an expert in and invest in that. Don't just randomly buy tons of stuff. I think they oversell like diversity is important too. It is very important, but they oversell it because diversifying into things you don't know about is not a good idea. Okay, that's like taking a chess champion and saying, you know what? Don't only play chess, play checkers, play play foosball. He's like, but I'm not good at those. So they're like, it doesn't matter. You should be diversified. Just because you're great at chess and win all the time, don't just play chess. That is not true. I mean, my friend who lives just down from me, he's an energy trader. He only trades energy. Not energy. I'm sorry, metals. Energy. I don't want to go to energy. Metals. He's a metal trader. He only trades gold, silver, copper. It's all he does. It's all he ever does. He has no interest in anything else that's happening in the market. All he cares about is metal trading. And it's funny because to him, I'm ridiculously diversified, and I am, but that's what I teach you guys. Because I teach people. So I look at lots of stuff. I look at a lot of mine. Plus, I've been doing this for ridiculous amount of time. I've been doing this since I was a kid. So I've just grown and grown and grown doing this with different sectors. But there's still stuff I don't do, like pharma. I really basically stay away from pharma. I stay away from biotech. It's not my thing. I don't know certain things, so I don't play them. All the stuff I play comes out of stuff that I've learned over the years. It's like I started very focused on tech. I was very fortunate. My father was a systems analyst. I knew all about them. I knew more about computers than most people on the planet when I was a kid, because my father was one of the foremost experts in computing, and he had, we had a computer the size of a refrigerator in his office, like a sideways refrigerator. It was gigantic, and it had this crappy little green screen, and he had to modem to NASA. He had to modem the tie into NASA just to play Pong. So like when we wanted to play Pong, we would have to dial up the NASA computer, use its capacity in order to get a game of Pong running. So that that's how long I've had computers. And the thing with and while you're playing, be careful not to put your hand on it for too long, because you burn yourself. So by the time PCs came out, I was like, I could take that apart and put it back together. So I knew all about computers. Then I understood the companies that were making them. I understood the chips. So I started off trading the computer companies. I started doing the chip companies. Then I started learning about, what's going on with the retail, and this is a problem. So I started looking at the retailers, and because I understood what the computer companies were selling, I understood their business pretty well. But then I started looking at distributing, the trucking, the shipping, and so on and so forth. And I started looking at that stuff. And so each time, like my knowledge grew out of the things I already knew and went to the next logical thing. When I got to the transports, I started looking at energy, and that became important to me. And this is when I was in my 20s. So it's like 30-something years ago, or it's like 35 years ago is when I started doing these things. And I went from energy to transports. The transports led me into shipping. And then I started looking at then I got into the delivery companies like UPS and FedEx at the time. Were very interesting, all the logistics, and then because of the logistics, I started looking at the companies that wrote the software for these things. It all sort of like grew out of one thing led to another, led to another, led to another, and I didn't trade things until I learned how they worked. And Buffett says that too. He says, don't trade things you don't understand. If you don't understand something, don't buy it. Because how do you know what it's worth if you don't understand it? You know, just because we buy a lot of things in the portfolio, but it's not to say you shouldn't have 50 things in your portfolio. You should have 5 things in your portfolio or 10 things, but the 10 things should be things you know about. Stuff you understand, and if you want to follow our stuff, then fine, pick the ones you agree with that you understand. Not just because you say, oh, I heard that's good. But you know, if you don't understand how GNC works as a company, don't invest in it. If you don't understand GE, and God, I can't believe how many people don't understand GE. Like everybody, like the fact that GE is at $8 right now, the fact that it was under $7 here when we added to it was the biggest. I just could not believe how many people, and I mean people and analysts too, and the idiots on TV don't understand how this company works. But it turns out to be true of most companies. Their basic premise is, oh, it went down, so therefore it could go down more. Or they have debt, therefore that's a problem. Sometimes debt isn't a problem. Sometimes debt is how you run your company. So recently, the reason GE has been flying up the last week or two is because they're selling off, they're looking to sell off their aviation division for $40 billion. And it's not even an important, it's not even important to them what they're selling, the leasing part of the leasing company. They're like, that's worth $40 billion. They've got little tiny things that are worth a fortune, and it's not even impinging on the larger business. All right, let's see if we have any questions here. No questions. Look at you guys. Am I that good or am I that boring? What am I doing? So GE, I said, it's new positions. We're holding it. GNC, we rolled the $40 calls that we owned we doubled down to 100 of the spread. So we took the calls that were 90 cents and we rolled to more than double, but still it's not that many, at 50 cents. So we didn't spend that much more money. We spent $1,400 more dollars. I said that right here. We're spending $1,400, capping our upside at $25,000, but $25,000 is a lot of money. I'll spend $14,000 to make $25,000, especially since our target, since we had the 250 calls, and to make $25,000 on the 250 calls, I wrote that we'd have to be at 850. This spread pays us $25,000 at 5 instead of 850, and GNC is already partway there. In fact, where are they now? I did not make that adjustment. I thought I made all the adjustments in this portfolio. Anyway, all right, well, so they're at 270 now. So you can still actually make that play. Oh, here they are, you can see. But as you see, we have nice improvements since then. Wow, I thought I made those adjustments. Either I missed that or I got a lot of adjustments still to make. I'm sorry, because I was away. This was what, the 26th? Yeah, I was away in Orlando with the kids. I only just got back Monday. Let's see. So HBI, we rolled down. HRB, I said, now we can turn this into a bigger trade because it was nice and low. So what do I do when it's low? And this is what I was talking about today in chat room. I said, what? It's not a bug, it's a feature. This is the way our system works. We take an initial position, and if it goes on sale, we take a bigger position, providing, of course, our premise doesn't change. With HRB, they didn't do anything wrong. People are still going to pay taxes and use their service. And HRB tends to do the same thing every year. They go down, they go up into tax season because everybody remembers them. In April, you know, your taxes are due, and everybody's like, oh, H&R Block, they must make a fortune. I just gave them money, blah, blah, blah. So everybody sees how crowded their office is. So everybody remembers to like buy H&R Block. They peak out, and then they go back down usually. Like not so drastic. This was a bad earnings report. But they'll peak out, then they go down, then they go back up, then they drift up, then people forget about them again. The funny company. It's like RRD. RRD is another one like that. That people just forget, and then all of a sudden they go back. Marijuana, MJ, the marijuana ETF, and again, let's buy back all the short calls, but the short puts are fine. I don't see any reason not to roll our 25 calls down. So we doubled down and rolled on here, and I said that means we're going to need $21,000. So I'm like, I didn't want to spend $21,000, so we sold the 30 calls, that's a half cover. We rolled to 40 and we did a half cover at 7,400 because I didn't want to be totally spending 21.4. So now we knocked our spend down to 14 something. And eventually we'll be able to sell, and even now we've got a nice bigger sell, but eventually we'll be able to sell another 20 for hopefully the whole 14,000 that we spent here, and then we'll have spent no money to move into a much bigger position. Micron, unfortunately, we were fully covered. I said unfortunately, we're fully covered. No sense in leaving the short 2020 calls open as they're down to 80. So in other words, if I wait a year, I'm only going to collect 80 cents. So they're pointless. So again, it's the mechanics, okay? It's taking me, it's not about emotion. It's not about saying, oh, wow, well, I wouldn't spend the $80 to buy these calls back. It's to say, what's the point? I can only make 80 cents. So if I clear the slot, I know there's like 5 different ways I can make more than 80 cents by clearing a slot. So we bought those back. The 10, 20, 20, 30 puts are 660. So we salvage that money, roll it to 15 short, I'm sorry, salary, we pay that. Then we roll it to 15 short, 20, 21, 25. So we drop $5 in price down way down to here at 475, and we picked up a small credit there. So we uncovered the calls that we have, and we rolled the puts down to a lower position. And we traded, we added 50% more, we added 5 more short calls, and we dropped the price by 5. So we didn't add very much margin at all, or maybe probably no margin, but we picked up a different position. And again, you know, why didn't we do that here or here? Because we sold. This is a good clue if you want to know what I think a stock is worth. We sold the $30 puts for $660. So at the time when we did the trade, I said, I think 30 is the floor. I didn't randomly pick it. I pick a striker which I'm happy to own the stock. So when we go to sell puts, or at least the net is where I'm going to be happy to own the stock. So in the case that we use that 660 and setting up a Micron trade, let's see what it looked like. Oh, MU. There it is. All right. So what do? We sold these puts on 10/15. We'd already made an adjustment, but on 10/15 we sold the $35 puts for $540. I don't know where it says 6 something. We sold the $35 puts for $540. So I said, that's odd. Why did I have totally different numbers? The 20/20/30 puts. What 20/20/30 puts? Isn't that weird? What was I looking at? Well, they were 35 puts. I guess I got in my head that they were 30 puts. Oh, I see, because MJ had 30 puts. That's what happened. I think I somehow I must have looked at these and because it looked like MU a little bit. I don't have good eyes, by the way. You guys probably know that. I think I can see, but sometimes I do that. I guess I thought it was a 30 puts. We have a 35 puts, so the net of this thing is 30. So when I have a net, you can be pretty damn sure that I think it's definitely worth the net, because that's my worst case to me, is being assigned at that price. So we hit 30, and I'm like, okay, that's it. I'm putting my foot down. We're gonna now turn bullish on this position, or more bullish on this position. And then we made those adjustments. So that's why we didn't do it here. We didn't do it here. But when it hits 30, I'm like, screw that. That's where I agreed to buy it. If I'm not willing to double down on 30, I shouldn't even be in the stock. NAK, what is NAK doing now? You're interesting. This is a benefit of having Trump in office, is that NAK is much more likely to be able to strip mine Alaska. Yeah, So they popped up nicely since. We didn't do anything with it, but it was too risky. But I said I said in a bigger portfolio, I double down, but this is a pretty speculative position. So that's where we are. OIH. Oh wow, I hope they improved. Same logic. The short 22 calls don't have enough left to give us, so we're buying them back to 80. The $10 calls, which is 240 for the roll, I'd rather double down to 40. So instead, if the roll wasn't worth it to me, because these are only 225s, and I still think this is way low for the target. So I said, we had 2 years. So I said, instead of rolling down for 250, I'd rather double down and see if it improves. And let's see how OIH has done since. OIH. Oh, very nice, right? So we doubled down instead, because I still think this target 15, which is over here, very attainable. So it's not like we needed to go to the 10s. I really think this thing's going to blast much higher once things settle down. SunPower. I was just an article just today. I said nuclear fuel is no longer viable. Not viable. Nuclear fuel is no longer cost effective. Solar is now so cheap. Solar is so cheap, and wind is so cheap now that it's no longer worth it to build a solar plant. And the coal plant also. Coal plants are not worth it either. So renewable energy, just by the market forces, is taking over. It's cheaper to run a plant that way. So I said 100 years from now we'll be using fossil fuels. No way. Maybe fusion, but definitely solar. The world uses $10 trillion. The world uses $10 trillion a year worth of energy. By the way, when I say something like that, I have to go research it. Usually when I say things like that, I'm like looking stuff up and trying to find out like the exact amounts and so on and so forth. So I remember looking this one up. It took me a while to find that number. We use 10 trillion a year worth of energy in solar at the moment. 2% of it. Solar is 2% of 10 trillion right now. That's all we're doing in solar. So the growth of this market is unbelievable. Even if you divide it by 100, divide 9,000 billion by 100, and it's still, wait. 9,000 billion. Oh my God. I can't do it. I cannot handle the math. All right, hang on a second. So we've got 9,000 billion is 10 trillion. Why am I doing 9,000? 112. Oh, I know, because it's 98. It's not $9,800 billion more than now. So that's the amount that solar isn't in energy. And we divide that by 200 50 times. So it's going to grow 50 times in 100 years, solar, or solar and wind anyway. So from where we are now to where, and that's not including any obviously additional use of energy that'll occur in the next 100 years, and I'd say we went from 0 to 10 trillion in the last 100 years, so I'm pretty sure we'll go from 10 trillion to a much higher number then. But even so, basically what you can say though is that we'll probably double on a yearly basis. We'll add $200 billion more worth of energy to solar and wind. So the industry as it stands now is probably going to essentially not double every year, but it's going to go up 200 billion this year, which is a double. Then it'll go up 200 billion the next year, which will be 50%. Then 200 billion the next year, which will be 25% of the total. And it'll just keep growing incrementally like that until it's a very significant amount of the energy sector. SunPower will be a company to make a profit, but I love the sector. I do like SunPower. There's plenty of room to grow. Even if it's only adding 1%, see, I'm very consistent with my thought process, because that's what I said here. Even if it's adding 1%, 100 billion a year for the next 100 years. So I said, let's blah, 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 and let's increase that one. That's another one we went after, and also everything's balanced here. I mean, what are you gonna do? SQQ, We were a little bit late because it was already bouncing, but we did the same roll. Walgreen Boots, another great one, another amazing company that I can't believe got this cheap. And I said, let's close what we have as left over from a spread. And so we closed what was left and we set up a brand new spread on WBA. And that's where we are on that. And Wheaton Precious Metals, as you know, this was our 2016 trade of the year. This is where we keep coming in. Nice pop, but only on the way to better things, I think. Let's behave and sell. Let's behave. So I said, let's behave. In other words, we didn't have a cover. So I said, let's sell some calls to cover. He just has to be responsible, and let's sell some March calls to cover. So even though I think we're going to go higher, I'm like, it's irresponsible to have 30 longs completely uncovered after we got such a nice pop. Because our 30 longs were up $1,300 at the time. And let's see what I did. I make these adjustments or did I not make these adjustments? I did not make these adjustments. So we're still at the same place. But I said, you got to cover. You have to lock in your profits. Otherwise, they slip away from you really fast, as we've all seen. So that's the adjustments we made. That's what we did when the market was crashing. Is we made all these different adjustments to take advantage of it. And if you don't do that, and if you I see a lot of people have margin issues and things like that. When times are good, you should have at least 50% of your margin available. So if the market drops 40% tomorrow, not likely to happen, but if the market drops 40% tomorrow, then you can say, oh goody, I have all this cash to put in. But if you're margin constrained and the market drops on you severely, you can't do anything about it. You sit there and hope that it comes back. And you don't ever want to be in that position. So you always want to have margin available. You always want to have things to sell. And what you have to tinker with your portfolio and work on it and eliminate positions that are costing you too much margin for their return. You know how I talk about margin efficiency? And I love trades that are margin efficient because we put in very little cash and it doesn't use a lot of margin. I love those because when they go down, it's like a reflex to double down. Right away, you're like, I'll double down. I got plenty for that. That works if you keep your positions margin efficient. If you don't have a lot of money and you don't have a lot of margin, avoid positions that are margin expensive. And you need to analyze the margin requirements for every position you have and understand what it's costing you in your portfolios. Rob says, we're approaching 2,600 on the S&P, which should be aligned to play for a pullback. Rob, 2,600 is the weak bounce on the S&P, and I guess you can. I guess you want to be bearish. I guess you want to be. I'm saying, not me. What is this? Oh, that's the old. I'm like, that headline makes no sense. It's just a weak bounce. See? Where is it? No, I'm sorry, it's not a weak bounce. It's a strong bounce. But I don't think we're going to get automatically rejected here. I mean, you've got the Fed has changed the fundamentals. The underlying fundamentals of the market have changed because the Fed has said they're going to get a lot more dovish. Okay, thing number two, the government will unshut. Another huge positive that will be a relief rally. Number three, China, we could any second now, they could announce a trade deal with China or a framework for a trade deal or whatever. All you have to do is have Trump and Xi suddenly shake hands from a secret meeting or something like that and have a picture go out, or even if Trump and Z both say, if Trump and Z both issue a statement saying we feel very good about an agreement and we will work out the details over the next 3 weeks, it's all they have to do, and you will pop this market 2.5 to 5%. So why short? Why do you want to short? Just because it's 2,600? Are you just looking for action? To me, it's not worth it. It's not. There's no particular reason. There's a technical reason. It may get rejected. It may have a little pullback because it had a nice run to 2,600. But it's not something I would jump on. And it's not the kind of things I like to play anyway. So I keep my money by not just playing something just because. All right, and I understand your logic. Your logic's not incorrect. Okay, we have a run from 2350 to 2600, which we know is a strong bounce. In fact, I laid it out right here. I said exactly what it is. It's somewhere 2360. So 2360 was the bottom. Where is it? So from 2360, so now we can work it backwards, and we say that 2600 minus 2360, 240 points times 0.2 is 48 points, so call it 50. So you're going to see, most likely, you'll see a weak retrace to 2550. That's the 5% rule. It's telling you that this run should have a weak retrace here. Now, what happened at the weak bounce line? That's a good clue also. So now we're back to here. The weak bounce line was 2480. So what actually happened? We had from 2360 to 2480, which is right here. We actually pierced it, right? See here, you got a little pullback, but we pierced it back to 2480. Back here, back to 2480. That's a big sign that we're going to go higher. Went a little bit higher, but then back down. So how much is a strong and weak retrace from 2480? So well, that's 120 points, so 24 points. So 2480 minus 24 is 2456. See that? And we never hit, obviously, 24 less than that would be 32. We never came close to 32. So basically what happened is we went up, we jiggled along the line, but mostly held it. Then we went back down below because Trump said something stupid or whatever happened that day. We held that 56 line. Let's see what a great sign that is. 56 suddenly becomes support. Went back up again, back, kind of hold 56 again. We went a little bit below it, but never made it to the strong retrace. And then we finally took off and broke out, and we made a run all the way here. So really, you'd have to say there was consolidation at 56, which means that you're probably only looking at the smaller number retraces, and the smaller number is going to be 24s again. So from here, you're looking at 75. So 70, 76, really, 75 right here. That's going to be your weak retrace. You're probably not going to make it all the way to 550. It's almost certain you're not going to make it below. And we're going to, and that's a strong bounce. So if you want to play that for the tiny little moves it's going to make, but look how erratic it was when it made it to 2480. Here's 2480, spiked up, hit 2480, went a bit above it, back down, back up. Would you have made money here? Would this be worth you sitting there and futzing around to make a tiny amount of money here versus, God forbid, it breaks up on you because they announced something and you get burned for thousands of dollars? It's just not worth doing. You got to have a reason to do something, not just because it's there. You know, this isn't Las Vegas. You don't like look at a freaking a spinning ball and go, oh, 36 black. You know, it's like that's not the way to play. You got to have a reason that you're doing it, not a feeling. Did anything happen that's negative? Did you read something that makes you think that this shouldn't hold? Do you think that this move has been too far too fast? No, it hasn't. Look how we're consolidating. That's very strong. That's a lot better than this was. We are slowly grinding up to the strong bounce line. That's a good sign. That's a good way to approach it. It's a lot better than when you zip up like this thing did. When you jump up like this, that looks like you're going to get rejected. And we kind of did, because 2480 is where you get rejected. So we got boom, rejected, boom, rejected a little bit, then back up. Now we start consolidating. Finally, we can make a move over it. But you can't make a move over it when you just jump up on this because you don't have enough volume behind the move. And again, not every time, but that's the gist of it. It said that there's not enough people buying. This is not these people right here, this volume right here. Okay, and then this volume right here, both end of the day volumes. Notice all this move is based on just a couple of end of day volumes. There was no real people buying here. This is just a couple of quick spikes and your whole run is here. So it's a forced move up. Then we held it for a week, that turned it real. Now for a whole week, people are trading back and forth saying, okay, we agree with these prices. So that's real, that's good consolidation. Then you kind of grind up a little higher. That's after a week. And we come back on Friday. People got enthusiastic because the Fed said whatever they said, and that gave us a little pop. And now we're kind of grinding along. People are digesting the Fed, listening to China, what's going on, listening to Trump, what's going on. He didn't go crazy yesterday. We thought he was going to declare martial law. He didn't declare martial law. So far, our democracy stays intact. That's a good sign. And we sit back and see what happens. But you've got to have a reason to do something. That's why you guys, I am constantly reading the news and looking at things, listening. I got in my office here, I got CNBC on. When I go into the living room to take a break, I have Bloomberg on there because I like to know what's going on both stations. I have it loud enough in my living room that I can hear it. So even if something happens, if Bloomberg's talking about something interesting, even if I'm in the office, I'll go out there and take a look and see what they're doing. All right, meanwhile, this rally's pulling back, so I don't know what. So again, rally's pulling back. So what's my reflex? My reflex is to go to the news and say what happened. All right, oh, that's interesting. What did I do? PG&E rebounds. Boy, they're so screwed though. Newsom signals he will deal with the company's problems as one of how is he going to deal with their problems? That's weird. Yeah, they got big problems. Anyway, I was actually thinking about making a bet on them because they have been super beaten up. Are they PGE? Is that them? PG. Oh, I guess we'll know when we see it. Nope. Shoot. Oh, PCG. PCG. Look at that. So we're not missing anything. I don't have a lot of conviction, but I did think that obviously since from last time you had this is a little bit overdone. But it's hard to do the math because you got to think about like their potential liability is something in the neighborhood of $30 billion. PCG, was that what I said? So their liability is potentially $30 billion. They're only a $9 billion company. Only 17 billion in revenue, 1.6 billion. So, the potential liability here is not serviceable. When BP had their thing, they had potentially 20 billion. We did the math. We figured they would have 20 billion in damages ultimately. Now, well, it's not an example, but at the time, BP was making $5-6 billion a year. They're erratic, but they still have the capability. Look at the sales. The sales are $250 billion. Look how erratic they are. Wow, they got crazy though. Now I wouldn't make the same decision. But at the time they were pretty rock steady with like massive amounts of money coming in. So I was like, they can pay this off. Because when you have a $20 billion fine, you don't pay $20 billion out of pocket that day. You borrow $20 billion and you pay it out of your cash flow. So when the company's down, you say, well, how much is this going to impact? How much will a $20 billion loan impact their cash flow? Well, it's going to cost them $2 billion a year for 10 years plus interest. And let's so figure $2.5 billion. So probably that's why. Actually, debt service is probably why. Yeah, look at this. Look at the not income tax expenses, interest expenses. Yeah, look at these. They're paying off. This is what they're doing. They're paying off their debts, and that's why they're impacted like this. But the point was, we said, well, that makes them worth this much. That makes them worth $130 billion. At the time, they were down like $60 billion. So I said, this is stupid. It's always an overreaction. Just like Apple, it's the same thing. Apple told us how much money they make. Apple said we're guiding down to 84 billion sales at 38% margin. That means I know this number. If you tell me what your sales are and you tell me what your margin is, that's your cost of revenue, then I know what your gross profit is. Not only that, but Tim Cook then told us his SG&A. He told us it was $8 billion, and he told us about. He even talked about his other expenses. In his letter, he mentions all those things. So it doesn't take a genius to say this is what our income is. And then he even talked about what the tax rate was going to be. He said our tax rate is going to be 16.5%. So we even know these numbers. So Tim Cook told us exactly how much money they're going to make, and it's still $10 billion. It's just math. It's not that complicated. There's not that many things. You know, and it all breaks down. And so it goes back to what I was saying before. If you understand the company, if you understand how they make money and why they do things, then all this stuff makes sense to you. Then when you hear about a catastrophe, you say whether or not it's good or bad. So the reason I jumped on BP is because they could service that debt. The reason I'm not going to jump on PG, whatever the hell whatever they're called, PCG or whoever they are, these guys, PG&E. The reason I don't want to jump on PG&E is because they're just a podunk electric company that really messed up. So I'm not sure the governor thinks he's going to fix, and the governor saying that doesn't make it so, because he doesn't know. You can't assume the governor knows what he's talking about. And okay, well, here's the good thing. Okay, I'll show you how my brain works. All right, California Governor Newsom. So then I go California. So the same thing I do with anybody who says anything. California Governor Newsom. Who are you? Gavin Newsom. Okay, so now I want to know, does he know what he's talking about? I don't know Gavin Newsom. He was born in San Francisco. Tesla, I don't care what Tesla is, business career. All right, he created a company, Pump Jack Associates. Group started Pump Jack Winery, so he's a wine guy. Blah, 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 Getty later. Okay. According to Getty, later business investments were because of the success of the first. So he started a wine company, had a good time with a wine company. Government health department business grew to 700 employees. That's very respectable. Newsom Investors opened several other businesses. He opened an inn, a cafe, a bar, development fund. Wow, very interesting. Bar, blah, blah, blah. Retail clothing. He's funny. And to that business holdings were $6.9 billion, blah, blah, blah. Okay, so he understands business. You have to give him that. This guy knows business. He's been in a lot of them. There's nothing wrong with $6.9 million. I mean, he's not Warren Buffett, but the guy certainly knows what he's doing. He paid $2.5 million for a house. That to me is not that smart, but that's what, I guess if you want to live in California, that's what happens to you. All right. So he's got good business experience. He does have some idea, but that doesn't mean he understands the electric business. It doesn't mean he understands the nuances of what it would take to bail out this company. I mean, honestly, let's say the damage is $30 billion, okay? Where is that thing? Here it is. Okay. So let's say this company is going to take a $30 billion hit on the damages. And the governor's thinking like, okay, well, but the logic the governor's using is saying, well, this is a public utility company and they're only going to pass that along to the consumers. So therefore, it's in our interest to try to bail them out or whatever. But that's not how the courts work. The courts, you sue them. You can't. The government can't stop citizens from suing the company. So the citizens will sue the company. They will get their damages if the company's kind of negligent. Believe me, in California, I mean, I would call for another venue because you're never going to get a trial in California that they're going to win. They're guilty, or they're already guilty, and you have a hard time finding people in California who don't think so. And I'm not even saying they are. I'm just saying there's no way you're going to get a jury of people from California who's going to say, oh no, they're fine. So they're looking at substantial damages, massive legal costs, billions in legal costs just to go through the trials. And down the road, fines, penalties, so on and so forth. So Newsom can have the best intentions to try to save them, to set up a fund, to do this and that, and blah, blah, blah. But eventually some accountant's going to go to him, the government accountant's going to go to him, it's way cheaper if we just let them go bankrupt and have another company come in and buy up their assets, and that becomes a new utility company. Or it doesn't, or let them go bankrupt and reorganize. It doesn't make any sense to bail them out and plow. Even if the government puts only $10 billion in, California can't afford that. You're going to wreck California's budget in order to do this. Now, on the other hand, you have other issues, though. It's got to be all looked at in a big context, because you've got all the insurance companies that have to pay this out. They're going to go, hey, where's our money? But they want to sue these guys too and collect something. So you're not going to make everyone happy, because the insurance companies want their pound of flesh. This company's got insurance. That insurance company sure as hell doesn't want to pay out $20 billion. So somebody's going to go bankrupt. And what you have to do when you're a government guy is you have to find the path of least harm. And not only least harm, but you also have to take into consideration, is this are we going to lose the election based on this? They have to take into account what constituency are you servicing, who's going to be helped the most, what's going to do the most public good, what's going to do the least total harm, which corporation benefits, which doesn't benefit. There's so much stuff to take into account. But the bottom line is, I don't think anybody's going to rescue this company from bankruptcy. So I think buying into them just because the governor says, I think we should help them, that's not a good reason to jump in. So therefore, given that there's thousands of other companies that are good values, I would just basically stay away from these guys. As cheap as they seem and as good as it looks, and they don't seem that cheap really. I mean, they make $1.5 billion in a good year, and you're paying $10 billion for the company. So yeah, it seems like a good PE. But going forward, these guys are going to get everything sucked out of them for years to come. So I would not play with this thing. Speaking of the pullback, look how we're pulling back on the S&P and the Dow, right? Okay, welcome, Rob. You're always happy with the points. Thoughts on long-term spread in Goldman Sachs for 2350? Yeah, I hate Goldman Sachs, but what can you do? They're going to make money. 150 is a very aggressive spread. Let's see where we're at. GS. Oh, actually, you know what? That's good. It's not that aggressive. Good move. I like this man. He goes in the money. So this is Rich. And Rich is saying that the 2021 150 bull call spread, 150-200 bull call spread in the money with a very reasonable target is 2350. So he will double his money there. I love it. I mean, that's, if you want to make 100, if you can stand only making 100% on your money, if making 100% on your money in 2 years, if that's something you can enjoy, which most people should enjoy that. Yes, I mean, I don't see that Goldman Sachs is going out of business. I think they're gonna, whatever changes, they'll reconfigure themselves to make money. You've seen them do it in the last crisis. whatever rule changes, whatever law changes, whatever happens, whatever comes their way, whatever market conditions, they will adapt and make money. You know, I actually like JP Morgan better because they have that underlying bank revenue that comes in. Goldman does not. If you find a similar play with JP Morgan, I don't know if they've come down as much as Goldman, but I like the backup of Chase Bank, and especially because then Chase Bank is then effectively backed up by the government. But no, JP Morgan never dropped the way Goldman did. So Goldman is particularly a good price right now. JPM. So JP Morgan topped out 115. They're down 15, 20%, right? So that's not thrilling. And again, you're not saying they're going to go back to their highs. Whereas Goldman Sachs took a big hit from 231. In fact, the same hit Apple took, right? They basically did the same. 231.50 is essentially the exact same drop Apple just had. Yet nobody's saying Goldman Sachs is going out of business like they're saying about Apple. You know, hey, they've only got those same stale financial products. They've been pushing the same things for years. They sell stocks, they sell bonds. They're not diversifying. They haven't come up with something shiny and new. They just make money. It's so boring. Okay, does that make you realize how ridiculous the arguments against Apple are? It's like, would you say that about Goldman Sachs? Would you say that about Ford? Yeah, they sell cars. They're a one-trick pony. They just sell automobiles. That's crazy. Look at Tesla. They just sell cars. They don't sell phones. They sell cars. But everybody likes Tesla. They hate Apple. It's weird. It makes no sense. So, yes, that's a very good find. That's any trade like that. Those are the kind of trades I do love in life. And 150 was a good solid base. Value-wise, I didn't have to look, but let's take a look anyway. I don't need to look at this because I know Goldman Sachs is worth 150 bucks. So Goldman Sachs currently has a PE of 13-ish. They're paying a dividend, which is not important to you, but it's good for the stock to have a nice dividend also. Rocksteady, same money because the same rich people. You know, they're not. You know, this is the fees they collect. The money. See, the revenue in a company like Goldman Sachs is the fees they collect from their clients. So they have very little cost to do it. The cost of revenue is money they pay out in bonuses and stuff. That's their cost of revenue. And then they have the SG&A. And that's more bonuses. So that's their salaries, that's their bonuses. They pay out. In fact, if you're Goldman Sachs, if you're a shareholder in these companies, you should be freaking out because out of $28 billion, they take $17 billion and pay it out in salaries. They're taking most of your money and just toss and giving it. They take it. Now the partners, which is everyone's a partner basically, but the partners just take all the money. And then they just declare that they have $11 billion in profit. It's a bullshit number. They took half the profit. They took 2/3 of the profit. This is all profit. The $32 billion is all profit. That's the fees they collect. Everything else is a salary of the people. Now, of course, yeah, you need to keep the doors open. You need to keep the lights on. They need some fancy offices. Fine. So let's say that that's legitimate. This is still half your profits. And it's basically, it's mostly bonuses and salaries to very, very high paid people. Now, their argument is going to be, well, if it wasn't for us, you wouldn't make that money. So we have a right to half the profits in salary. It's tough, you know, but basically it makes them effectively the most expensive hedge fund ever because they're taking half the profits for themselves. But you know, hey, look, they make the money, right? They make $8 billion. You know, that's the thing. Do they make the money? And this hedge fund returns. Let's assume that's an aberration, right? And then see how they had a high tax expense. I think they repatriated some cash. So they had a high tax expense here. That should stay out. So this is actually a throwaway number that you wouldn't think is going to continue. And if we look at this year, broken down into quarters. You always have to think of all these factors, right, when you're doing stuff. This year, see how the tax normalized now? They have this big tax hit they took here, but now they're going to make $10 billion this year. So they're going to make $10 billion on a $65 billion market cap. So they're returning 10%, 15% to the bottom line, even after they take that incredible amount of money off the table. And that's the other thing about Goldman Sachs that you look, as an investor in Goldman Sachs, you're going to love this. They can make their number, they can make their bottom line say anything they want because they're giving out, it's all discretionary money. That bonus money is discretionary. These guys make double what they make in salary and bonuses. So they can adjust it, and they can adjust their bottom line accordingly. So, definitely yes to Goldman Sachs, and that's a fantastic spread. And I should probably add that to one of our portfolios because it's just really actually on the OOP, because it's basically you take 10,000, turn it into 20,000, and it's very low risk. So when you have a low risk way to make 100% in 2 years, why would you not do that? I might even put that in the hedge fund. That's how good that is. That should probably go in the hedge fund, because it's kind of like, those are the kind of plays we like in the hedge fund, is things that are very, very bulletproof kind of trades that you can make. Now, of course, myself, if I was doing a trade like that, I would want to, I'd also want to sell some puts. So if we go to 2021, given that we don't think they're going to go below 150, we can sell 150 puts for 16 bucks. We can sell 140 puts for 13 bucks. We can sell, that's 11. I think I'm very comfortable with the 140s. So let's say we sell the 140s for 12.50. Okay, and this will be a long-term portfolio play if it's too good not to do, and I'll probably put it in the hedge fund too. So let's say we sell 5 of those. That's not very risky to own 500 shares of Goldman Sachs is the worst case. So we'll sell 5 of those, and we'll collect $6,000, and then we'll buy, as you said, the 150, 200 bull call spread. And by the way, before I do that, I want to see if the 140, that's 50, 140, 190, 50, and 20 is 30 bucks. No. So that is better. So if you can do this one said, well, 1730 is wrong. That's too low. 18, I'd go 19 here, and the 150s are 43, let's say. So 19 and 43, that's 24 bucks. That's fine. Okay, so that's 24 bucks. The 190s are 20. Let's say they're 22 and the 140s are 50, that's 28. No, that's too much more. So it's not worth it. I wouldn't spend 28, but 24 is right. So I would do the 150, 10 of them, the 150, 200 spreads for $24,000, offset with the $6,000 sale of the 140 puts of 5 of them. So now you're netting into the spread for $18,000, and your upside is $32,000 if you hit 200. And I don't consider that very risky. Your worst case is you own Goldman Sachs for 140. Your best case is you pick up 50,000 bucks on the spread. So that's the way I would do that. But again, there's your margin issue though, because if you look at Thinkorswim and you try to figure out the margin, you're going to get charged. So, is it worth it? Sell single 5, 7,000 in margin. So the question is it worth $7,000 in margin to do that versus just taking? See, that's the thing is if you do it with cash only, in order to make 32,000, you have to put 32,000 in cash in. By doing it with margin, you only have to put in 18,000 in cash and 7,000 in margin. So it's margin. That's what margin efficient is. The cash and margin, you're saving $14,000 in cash and using $7,000 in margin. That's margin efficient. Obviously, you're going to come out ahead on that. It doesn't work in an IRA, but this is just an ordinary margin thing I'm using. So it's not even portfolio margin. So that's how you want to analyze your trades when you're doing these things. All right, so time to wrap this thing up. Let's see how everything's doing. Oh, the indexes came back already, so there wasn't really much of a crisis. It's so funny. The market goes up and down 100 points. You're like, yeah, well, whatever. Oh, there's Goldman Sachs. Isn't that weird? Were we talking about it last week? Because I sure didn't do that just now. YM. So now we're up 144 in the futures. Futures don't correspond exactly to the indexes. So been up and down and up and down. We topped out at 96. We got a bit of a rejection, so we'll see what happens there. The Russell is plowing high. See, this is the thing. Remember what I said about drifting. It doesn't matter where they drift in between the lines. What matters is if you make the next box. Excuse me. If you make the next box, and the Russell is the one that has to get up there because they're the only ones that are still dragging everything down. Once you get the Russell over 1470, things are going to look a lot better, and we should be able to pop very nicely. And you know, I imagine they're going to be pushing if they're trying to manipulate the markets, they'll be looking to make an announcement, either a government opening announcement or a trade announcement will probably be made at some point this week before, you know, in time to make a nice finish for the week. Oil's chugging along, Brent's chugging along, gasoline came up nicely. Remember I said gasoline was lagging if you want to play. And natural gas seems to be holding $3, so that's good. Gold and silver recovering. Dollar's still very low. All is well, I'd say. No real issues. Any new questions? Ian says, Ian Fleming. Ian says, Goldman has a pending issue with Malaysian government for $7 billion in reparations due to fraud. Yeah, that's, again, it's bullshit. You know, you know, they've got enough money where even the government of Malaysia will get annoyed and settle, you know, and the settling will be fairly inconsequential to their bottom line. So, you know, they can ask for $7.5 billion, but I'm pretty sure they're going to be thrilled to get $1.5 billion from Goldman Sachs. And if they can even get that. You know, so it'll drag out, it'll be time. That's the other thing, by the way. It's like Exxon, the Exxon Valdez, it took them like 15, 20 years to finish with the court cases on the Exxon Valdez. They actually, you know, they drag it on. So first of all, half the plaintiffs die, so they don't have to pay them. And also people just start giving up. You know, things give up, they run out of money, the lawyers run out of money. Then, you know, these companies will bankrupt an entire law firm dragging these cases out. The law firms have to respond. Once a law firm takes on the business, they've got to respond to this kind of stuff. And these guys will bury them in paper and cause the law firm to rack up millions and millions of dollars in bills to the point where the law firm is like, we got to settle this thing. And they start putting pressure on the clients to settle. So, you know, Malaysia is just going to have to really abide by whatever the international court ends up doing. The international court is not likely to give them $7.5 billion in reparations. The whole fraud wasn't anywhere near that. So they're looking for damages and all sorts of things. And the reality is there'll be a partial, you know, there'll be a partial contributory negligence on the damages by Goldman Sachs. And they will probably pay something, but I'm guessing the most would be 1.5 billion. And that's, you know, and that'll be after going to court for a couple of years. If they want to get the money quickly, Goldman Sachs will give them $500 million tomorrow and make it go away. But probably it'll drag on for about 2 to 3 years, and in the end, Goldman will write a check. So even if they drag it on for 2 or 3 years, all they're doing is giving them $500 million a year for 3 years. Every year, Goldman puts a little aside, a little aside, a little aside, and then for the next 3 years, they make it up, and that's that. It's nothing to them. It's like it's just barely above a wrist slap. And you know, this is not the only thing Goldman does. This is where their money comes from. They're constantly doing stuff like this. This is just one they got caught on. You know, and all these banks do this kind of stuff, but they don't get caught usually. But if things go completely sour like this thing did, then yeah, they're going to get caught and everybody starts finding out what happened. Alistair says, quick thought on a new position in Apple. Short 5 Apple January. Yeah, sure. Of course, I think Apple's well worth that money, and you're netting in for 129. So as long as you really want to own 500 shares of Apple for 129, which is about $60,000 worth of Apple, as long as that's comfortable for you, then there's no reason not to do that, because you're going to get $10,000 just to promise to do that. Your promise to buy $60,000 worth of Apple is worth $10,000 to somebody. So yeah, why not? I do want to own $60,000 worth of Apple at net 129. I'd love that. So if you're going to give me $10,000 to do something I love, those are the kind of trades you want to look for. But you have to then consider how much of your portfolio's buying power is going to be tied up in this, and is that worth making $10,000? Is that the best use of whatever resources you're tying up? Can you do better? And that's how you always have to look at these. Can I do better than that? Can I have a better way, a faster way of making, a surer way of making $10,000 than this trade? And again, it goes back to, like I said, in the long-term portfolio, the margin on that trade, I'm guessing, would be no more than $20,000, and probably less, but I'm just saying on the outside, let's say it's $20,000 in margin on this trade to make $10,000. That's not margin efficient by itself. But, and again, if you're in portfolio margin, that's a non-issue. And obviously, if you're making a trade like this, you better have portfolio margin, because if you don't have a $100,000 portfolio, then what the hell are you doing with this trade? But if if you have plenty of margin, like you do in the long-term, short-term portfolios, it's just sitting around doing nothing, why not pick up $10,000 then? It's better than the interest in the bank. If you're tying up, even if you're tying up the whole 60, it's better than the interest in the bank. If I have $60,000 laying around doing nothing, why don't I sell a put on something I'm willing to buy for $60,000? You know, like my daughter's going to school. I know she wants to go to school, so I'll sell a put on my daughter's next year of college. So instead of $50,000, I'll sell a put for $40,000, and they'll pay me $5,000 for the put. I know I want my daughter educated. I know I'm going to spend the money. So what better use could there be of the money than put it aside? Same thing for stocks. If you know you have money and you know you want to buy stocks, why would you not sell puts? It's what you want to do with the money anyway. But the question is, do you overcommitting? Because so long as you're not overcommitting, go for it, because that's a great trade. It's a great price. It's a great trade. Whenever you have market crashes like that, that's where your mind has to go. What do I see that I really want to own? What is now so cheap that I really can't resist it? And I said that the other day about Apple. I made a general comment about Apple. I made a trade on Apple. When it was down to 140, I said, that is it. It's time to back up the truck, sell the house, do whatever it takes, get all your money together, and buy as much Apple as you can afford. And we did that. We did that in the hedge, not as much as we can afford, but we actually made Apple a much more significant piece of our hedge fund. We did it in our portfolios. We increased our positions on all the Apple stocks. We bought back the short calls. We rolled down the strikes to the $140 level. We made every move we could to increase our position in Apple and make it as good, as strong as we could, because we had the opportunity and we weren't going to let it go. Do we go to 140s or 120s? Well, whatever we went to, it was worth it. I think we went to the 120s. I'm sure in the hedge fund we went to the 120s. So in the hedge fund now we have 120, like 180 spreads, and short puts. You know, that's gonna pay back $60 if all goes well, and we'll make 200, 300% on that position, and it's a large position, because there's not much in the market I have more faith in than Apple coming back over the next 2 years. Because it's a money, like Goldman Sachs, it's just a money printing machine. And like Goldman Sachs, if the market changes and if everybody wants glasses, Apple will put out glasses. And if everybody wants something that vibrates on their arm, they'll give them something that vibrates on their arm. Apple's not stupid. The reason that their primary income comes from iPhones is because every single person on the planet walks around with a freaking phone. This is where analysts are idiots. Okay? The #1 consumer electronics maker in the world has most of their income comes from phones. Why? Because who do you know who doesn't have a phone? And I don't mean who do you know personally, who do you know, like go outside now, walk down the street and find me a person who doesn't have a phone. And that goes for probably 4 out of 7 continents. Everyone has a phone. That's where the money is. That's what they sell. So these analysts who say, "Oh my God, they just sell phones." It's so stupid. It's like saying that Ford just sells cars. Everyone drives a car. Ford decided that's a good thing to sell over the 100-year period of their existence. Ford did not get into phones. Ford did not get into airplanes. Ford did not get into couches. They sell cars because people buy cars, and after a few years they buy another car, and then they buy another car, and then they buy another car. And Ford makes a lot of money selling them cars over and over and over again. Apple makes a lot of money selling phones over and over and over again. And yes, there are other phone makers, just like there are other automakers. That does not stop them from making money. All these negatives on Apple are just short-sighted people who don't have a real view of how companies make money. And again, it goes back to the same thing. You don't understand how companies operate. If you think Apple's a bad company, then you don't understand how Apple works, and you don't understand how these kind of companies make money. Nobody in a history of industry has ever made more money more consistently than Apple. And there's no sign of that stopping. And it doesn't mean they can't have a bad quarter, and it doesn't mean they can't have a bad year. But overall, there would have to be a massive upheaval in the way things work for them to stop making money. And that's just not happening. And even a Chinese boycott isn't going to stop that from happening. Because what Apple does in a Chinese boycott is they concentrate their sales on other countries. So China was 20% of their sales last year. If they had a fully effective boycott, which obviously is never going to happen, but let's say, it's probably 50% now, so it's going to cost them 10% of their sales. So a big Chinese boycott's 10% of their sales if it lasts a year and so on and so forth. But let's say worst case 10% of sales. So what does Apple do? They do what anybody would do. They say, well, let's take the rest of the world and try to boost our sales 10% to make up for it. And they're not going to do that in one quarter. But as they decide that China's not coming back quickly, then they would say, okay, well, let's do this and let's do that. Let's spend more in North America. Let's spend more in Canada. Let's push harder in Africa. Let's get into Europe and do this. Let's make a deal with this guy, make a deal with that guy. They just made a deal with Samsung. Apple just made a deal with Samsung to put their stuff in Samsung's TV. So in Samsung smart TVs, you now have iTunes and stuff. You now have the Apple App Store on a Samsung TV. This is not a stupid company. They will adapt and survive and thrive. So, when you get opportunities like this to buy companies that are great for this kind of money, you have to take it. And you can't let idiots panic you out of positions. You can't let people who look at charts and think that just because something got cheap, it's going to get cheaper than that, because that's the way it's going. It's idiotic. It's like someone telling you that your car, it's like the guy next to you in your car sees you go from like a zero, you're pulling out of onto a highway, and you go from 0 or from 20 to 60 in 30 seconds, and they say, oh my God, you're going to go 180 in the next minute and a half. And you're like, no, I'm not. And they're like, yes, you are. You saw it. It's absolutely going to happen. I just saw it. Look at what happened so far. And you know that the speed limit is not 180, that the speed limit is 60 or 70. You know your car can't do 180 even in the best possible conditions. You know you're sure not going to drive that fast anyway. That guy's clearly an idiot, right? But that guy's what you call a TA guy. He's a chartist. He sees some lines and he extrapolates the lines and he decides that everything else has to fit in his premise of what's going to happen. They don't know anything about the company. They don't understand how it works. They just make and they're invited on TV as if they know what they're talking about. And yeah, what they do is they see this line and they look for things that justify their premise. They say, oh, soft iPhone sales. Oh, the new iPad bends or something like that. You know, and yes, of course it bends. It's a big flat piece of metal, and if you push it, it's going to bend. Don't do that. It's made of glass too. If you bang it into something, it shatters. But we've already had that discussion. I think that's already, people have accepted the fact that things break. I mean, it really is funny. It's just, you know, people don't understand how the company actually works. It doesn't matter to them. They just decide it's bad and they're going to start shorting. So anyway, so that's why we went gung-ho crazy on Apple. That's why I said more Apple last week. That's why I said more Apple today. It's just, if you don't have Apple as a significant part of your portfolio, you're just not trying. That's where we are. Even at 153, which is now 10% off the bottom already, it's still way a bargain. And with that, we will conclude the webinar. Everybody have a lovely, lovely weekend, and I will see you all next week. All right, thanks. Oh, wait, I will see you next week because we got that marijuana convention. No, probably not going to do it next week. Sorry, so we're going to skip. But week after that, all right? We'll be back to normal. Thanks. Bye.